Hello, this is Edmund Shane. In today's presentation, we're going to look at whether we're in a bull or a bear stock market and which sectors you should favour. Firstly, it's not time in my view to change my bullish stance. I have been bullish on the stock market for quite a while. I don't see that this is the occasion to change that view. Firstly, of course, there are worries, in this case focused around the emerging markets. In this chart, we can see that both the ruble in Russia and the Turkish lira have sold off against the dollar. In other words, the lines are going up quite considerably over the last couple of months since the end of 2013. So there are some intensifying concerns around what is happening in Turkey, what is happening in the Ukraine, and knock-on effects to Russia. That is for sure. However, when we look at the volatility situation within the stock market, and for this we can look at the VIX indices in the US, we can see that these volatility indices have actually fallen back an awfully long way. Here we have the midterm volatility index, which reached a peak of 20 at the end of January and is now back down to a measure of only 15. So volatility has calmed down an awful lot. So the fear in the stock market seems to be disappearing. Equally well, if you look at the black line on this graph here, you can see that the average stock, which is what is represented by this black line, is not far off the highs reached back in late January. So we've already recovered quite a lot of what we had lost in the emerging market sell-off. This is also true, in fact, is even more true in Europe. We can see from the yellow line, which is the European small cap index, that we have actually exceeded the previous January high and are making new highs. And this is also the case for the average European large cap stock shown in the line in black. So Europe, in fact, looks even better right now than the US stock market. Now, if we turn to momentum, one way of measuring momentum is the Advanced Decline Index in the US, and this measures how many companies, how many stocks have risen on a given day minus those that have fallen. This is what we call then a cumulative index, so we add up the movements for each day to get an idea of the overall trend. This line is here in black at the top, and as you can see, this Advanced Decline Index on a cumulative basis has hit a new high. So it underlines the fact that stock market momentum is actually very positive. And yet, when you look at this chart from Investors Intelligence, which looks at professional advisor sentiment, they're actually not so bullish. You can see at the bottom chart here, the black line has headed straight down, which means that advisors in the US have become less bullish and have become more cautious. So there's no over bullishness, I would say, in the US stock market at the moment. So which sectors do we prefer? Firstly, technology. You can see here that the technology sector since the middle of December, the line in black, has outperformed the market quite handsomely. We're seeing very strong momentum from a number of companies, led up by, of course, the social media companies, but also focusing on Google. I would also focus on a number of networking companies like Corning, like Juniper, that are also doing extremely well and hitting new highs. What is also true is that earnings for technology stocks are still way ahead of prices. So prices are effectively still catching up to the strong earnings trend that we saw over the previous few years. So that suggests to me there is still more to come in technology. Secondly, healthcare is another area of strength both in the US and Europe. You can see here that the US healthcare sector has outperformed the S&P 500 benchmark index quite considerably since the end of December and is in a nice acceleration trend. I see this continuing in the short to medium term. And finally, mining is the third sector. This is interesting because it's been a bear market for mining stocks really for the last couple of years. What we can see really only since the end of January is a decisive breakout from this downtrend and starting up a new bullish trend. So companies such as Rio Tinto and Anglo American, and if you want to be more sporty than the gold miners, for instance, in the US, are all starting to bounce really quite strongly. To summarize then, there is no real evidence that I see of a stock market breakdown. All my indicators remain pretty bullish. European small caps in particular are in focus. They're breaking out to the upside and making new highs. I like technology, healthcare, and the recovery in the mining sector as the three key sectors to play going forward. This is Edmund Shing saying thank you for watching, and until next time.